So what is the right mix of stocks and bonds for those of us of a certain age? There's been a lot of talk about this recently. Bank of America Merrill Lynch put out a note to clients that the old 60-40 portfolio allocation is dead. Burns McKinney joins us now to talk about that. He is with Allianz Global Investors. So, where are we going to go for growth and especially for income of a certain age, as long as we're living longer these days and interest rates are as low as they are right now? What do we do here, Burns?
Well, being cognizant of the fact that there's no one-size-fits-all rule for all retirees and for all baby boomers, I think that when you do see that are more and more holding a greater proportion of equities than would be suggested by this Fidelity model, it's really just a symptom of this world of ultra-low interest rates. You have a supply-demand issue whereby the supply of yielding alternatives is very low. You have low bond yields, the lowest they've been really in history,
right,
and the demand for yield is very high. You have, again, the baby boom generations really at not so much the capital gains, but at the harvesting and the cash income stage of their investment cycles. And so you have an entire generation of investors who are just searching for yield anywhere they can get it. And so some of the old metrics maybe need to be updated, but at the same time, I think that these are just people that are looking for income wherever they can find it.
And you say that makes diversification key.
Absolutely. I think that diversification is always crucial, and with people living longer, as was previously noted, I think that there is a case to be made for perhaps having a little bit higher allocation to equities. But within that, if you're looking at retirees and people within the ages of 55 to 75, they should probably look at equities that are more than anything paying attractive dividends, companies that are a little bit higher quality, and in many cases to reduce risk and reduce volatility, looking at larger cap names that might be a little bit more domestically focused.
Where do I go when I'm not in equities and I want income of some kind? I mean, the old master limited partnerships and some of those things that were so popular a generation ago. Do I look at those still these days?
I think that there's a case to be made for those. I think that there should at least be some allocation to, I think one that'd probably be a little bit contrarian would be to inflation-adjusted treasuries. Right now you have inflation expectations are the lowest they've almost ever been, and so you can't imagine them going too much lower from here, which would make a case for these securities. But really, I think that I think investors should have a dynamic diversification of their portfolio whereby they reduce that equity exposure as they age, set targets which suggest that if you have a year like this when stocks are up 20+%, then when you reallocate at the end of the year, maybe take a little bit of your winnings off the table. That's something that really forces investors to, by definition, buy low and sell high.
Indeed. The old that doesn't die, that adage right there. Burns McKinney with Allianz Global Investors. Thanks again for joining us.